Thank you for that generous introduction. I'm going to talk today about new research about the effectiveness of tax enforcement initiatives, what works and what doesn't work. Today, in my talk, I will have three objectives. First, I want to start with some big picture thoughts on what mostly determines compliance, with the two alternatives I'll propose are deterrence or something else. Second, I will discuss some notable recent research on the effectiveness of tax enforcement initiatives. And then finally, I'll just give a flavor of a very recent research project of mine about one particular enforcement initiative, and that's the U.S. passport revocation program for extraordinary debtors, meaning that now in the U.S., if you owe over a certain amount to the IRS, you can be prevented from getting, renewing, or even having a passport. And then finally, I am going to be sure to leave plenty of time to talk to you all, to answer questions, to discuss anything on your minds that I didn't cover in my talk. Okay, so first part, some big picture thoughts on tax compliance. So I think the big picture issue in what determines tax compliance is how much of it is deterrence. By AS here on this slide, I mean the Allingham-Sandmill model of deterrence, where people and businesses' evasion decisions are determined by the probability they will successfully evade, the perceived probability in particular, and the perceived penalty that will follow if their evasion is detected and punished. I have seen many papers over the years about alternatives to deterrence that somewhere on the first page have the following argument, which I've summarized here in quotation marks. And the argument is something like this. Well, and I'll use US numbers. The audit coverage, meaning what fraction of income tax returns is audited, that is less than 1%. That's a fact. And the penalties for detected evasion are not punitive. It depends whether the evasion is determined to be fraud or not, but most detected evasion, the penalty is 25% of what you evaded. So you have to pay what you should have plus 25%. In rare cases, that goes to 75% if it's fraud, and in very rare cases, you can go to jail, but that does not happen often. Okay, so with those parameters, chance of being audited less than 1%, and those penalties, if you plug in those parameters into the Allingham-Sandmill model, and then plug in the other key aspect of the model, the risk aversion of the potential taxpayer. The model predicts that we would have a level of tax evasion way higher than what we observed, 10 times higher, maybe 50 times higher. Therefore, this argument goes, the deterrence model cannot be the important factor in constraining evasion. So I have read that argument many times. I have written many times about why I think it is a flawed argument, but I'm going to take the opportunity today to tell you why I think this is a flawed argument one more time. What matters in the deterrence model is not the fraction of tax returns that is audited, which in the US is less than 1%. What does matter is the perceived chance by the potential evader of being detected. For most evasion of employees in most developed countries, the perceived chance, that should say perceived rather than objective, the perceived chance, but it's also the objective chance in the United States for employee is much closer to 99% than it is to 1%. Yes, it's true that less than 1% of returns are audited. But if somebody like me, an employee, decided not to report my income from the University of Michigan, the chance the IRS would discover that when matching what they learned from my employer to what I report is much closer to 99% than it is to 1%. So what matters isn't the fraction of returns being audited, it's the objective and therefore which influences the perceived chance of being detected. If you plug in 99% perceived chance of detection into the Allingham-Sandmill model, you will get a level of evasion for wage income, which is in the ballpark of what we observe. So this often cited argument for the ineffectiveness of deterrence, I think, is just a flawed argument. Well, what about evidence for the effectiveness of deterrence? Well, to me, the first most compelling argument is to compare the non-compliance rate or the evasion rate for self-employed taxpayers to those of wage earners, employees. For employees, the P, this is the P from the Allingham-Sandmill model, the probability you'll get caught and punished. As I said, that's about, in the US, about 99% for employees, but is much lower for self-employed taxpayers. There is no third party telling the tax agency what a self-employed taxpayer earns, although I'll talk in a few minutes about some substitutes for that. So the P is much lower. The probability of punishment is much lower for self-employed taxpayers. And sure enough, all the evidence we have suggests that their non-compliance rate, the evasion rate, is much higher. And I believe it's not because there's something intrinsic about the honesty of employees versus self-employed taxpayers. It's just that they correctly perceive a very different chance of being caught. And as I'll discuss later, today, much recent research has established that enforcement initiatives which do change perceived P and F being the level of punishment in the Allingham-Sandmill model, do reduce non-compliance, just as the deterrence model suggests. And finally, and probably most controversial, I believe that most recent research fails to find an effect of non-deterrence policies of the type I'll talk about in a minute. Now, two things. First of all, I acknowledge that it's not true of all recent research, but I do believe most recent research of this kind fails to find an effect of non-deterrence policies. Certainly, most research of the kind I'll talk about today. Now, second, I certainly recognize that some people are motivated by non-pecuniary factors in many decisions they make in their life, but I find the evidence in this context, meaning tax evasion, to be mixed at best. I recognize that some people are motivated by non-pecuniary factors because I married one of those people. My wife is, I see every day, is motivated by these kind of non-pecuniary factors that I'll talk about in a second. So I have had my eyes open, and I know there are people like this, but I do think the bulk of the evidence suggests that this is not what is important, and also is not what is subject to policy adjustment in terms of affecting the level of evasion. So you all know this, but let me just say what I see as the main alternatives to a deterrence model. First, civic duty, intrinsic motivation, which might be motivated by patriotism. As I said, I certainly understand there are, in some situations, some people for whom these things matter. Second, social norms or conformity. Signaling, I think with evasion, signaling is not that important because tax compliance is not a public activity, although I'll talk about public disclosure of detected evasion later in this talk. Some people will claim that have claimed that evasion levels depend on the perceptions of fairness of the tax system, which certainly seems plausible, but of course would not matter in an Allingham-Sandmo deterrence model, because what matters is whether you think you'll be caught, and if you're caught, the level of punishment, the perceived fairness doesn't matter. Some people have argued what the government spends tax revenue on matters. Notice that this and the previous bullet are violations of the free rider assumption of the Allingham-Sandmo model, that you are just one taxpayer of, in the US, over 100 million taxpayers. And if you're trying to influence how much government revenue the government has to spend money on by not remitting your tax, you're just a very small drop in the bucket. Now, a lot of the evidence about things like fairness affect people's behavior depends on lab experiments. And I worry that what people have discovered matters in lab experiments. Do you think that the people you're dealing with in the lab experiment are kind or mean, whether you trust them or not? I worry that about whether those notions carry over from things that matter when one person deals with another person to what matters when one person deals with a government. And finally, behavior toward authority. You all know about the classic lab experiments of Milgram, which at the time discovered quite compelling and always controversial evidence about what influences people's behavior toward authority. And of course, the tax agency is an authority, and I have always found it interesting that people in our field of tax evasion have not thought more about what we know about behavior toward authority and what influences that affects tax evasion. Okay, so that's my 2 cents on the big picture issues about what affects compliance. The bulk of what I want to say is in part 2, recent research on what works and what doesn't work in changing tax compliance. Okay, so first, a note on methodology. And in this group, I want to say that I acknowledge and I embrace the difficulty of empirically studying a phenomenon that is by its nature very difficult to measure. I have been dealing with graduate students for many years, and I notice that some are put off by this field because the thing we're trying to study is very hard to measure. You can't just go look to the Bureau of Labor Statistics and get time series on tax evasion by occupation, over time, by geographical area, as you can, by quarter, as you can for, say, labor supply. So I understand that, and to me, I embrace that. I have found that this difficulty demands creativity, and I find that fun and exciting. And I think a lot of you in the audience are in this group, and I applaud all of you for not being deterred by the challenges of measuring the left-hand side variable in what we study. So I think the two major kinds of empirical analyses of this hard thing to study, tax evasion or non-compliance. One is to study traces of non-compliance, what I have called in an earlier paper, evidence of the invisible. And I think there's some great, very creative, often very compelling research projects that use traces of non-compliance. That is, they never have measures of evasion, but they come up with conclusions about evasion that are compelling. So the second one I have here in the examples is the classic study by Pissarides and Weber, where they look at the ratio of food expenditure to reported income by employment status, meaning comparing employees and self-employed people. Holding income constant, they notice that the ratio of food expenditure to reported income by self-employed people is much higher than it is for employees. And since that's a ratio, that could be due to a couple things. But if you assume that there's nothing about employment status which affects how much people at a given income level, how much food they want to buy, which I think is a perfectly plausible assumption that has been verified in many studies, the fact that that ratio is higher for self-employed people implies it is a trace that their reported income is lower than their true income. And I think that is, well, that is certainly the classic study in this field. I still find it compelling these many years later. I'll just mention one other example of a traces of non-compliance study that I really like, and that's a study done of Greek banks. And the issue is this: Greek people come into Greek banks and they want to get loans, and the Greek banks ask people to bring in their income tax return so the bank can get a sense of how good a risk the person is. And it turns out that the data from the bank that this study has, the banks are clearly aware that what people report on their income tax returns is not necessarily their true income. And sure enough, the lending decisions of the banks, this profit maximizing bank who really want to judge correctly what the risks of potential borrowers are, they make decisions as if they inflate the reported income of self-employed people by a hefty factor relative to what they do with the reported income of employees. So these profit maximizing banks reveal a trace of non-compliance because they act as if the true income of self-employed potential borrowers is a large factor higher than what they report. The hot approach now, though, is not traces of non-compliance, although I don't mean to say that there aren't still plenty of fascinating work that can be done in that area. The hot approach now is randomized controlled trials, which have been called the gold standard in establishing credibly the causal impact of policies. And I agree with that. And it was maybe now about 15 or 20 years ago when I realized that what I'll call RCTs from now on, that RCTs are the gold standard of compelling identification. I remember it well because once I realized that, I thought that was going to be very, very bad for our field of taxation. Very, very bad because I thought, well, what government is ever going to let an academic do a randomized control trial on the tax system? What they're going to say, everybody whose last name starts with a letter between A and M, you have one tax rate. And if your last name starts from N, a letter N to Z, you have another tax rate. That's never going to happen. And so in our field, we're never going to be able to do RCTs. The labor economics folks are going to be doing them. The development economics are going to be doing them. And we are going to be lost. We are going to be left behind. And it turns out that this very despairing view from 15 or 20 years ago has turned out not to be true. It turns out that many governments are willing to work with academics to do RCTs, usually not on the tax rates themselves, although there are now some exceptions, but certainly about aspects of their enforcement environment. So what I'm going to do now is talk about a few RCTs about tax enforcement, which I think are very well done and provide compelling results. Okay, so the first set of studies I'll talk about are notification initiatives. So what that means are, okay, the tax authority contacts a taxpayer or somebody they think should be a taxpayer, an individual or a business, in one way or another. I'll talk about the different ways they can contact taxpayers. On this slide, I've said, well, when they contact a potential taxpayer, what might they say? I wrote letter here. What might a letter from the tax authority say? But as I'll say soon, it doesn't have to be a letter, but it could be an email, could be a phone call, could be a visit. But there's lots of different things a notification can say. One is, and this turns out to be very important for identification, it can just be an official letter from the tax authority, which basically says, hi, how are you doing? Having a good day? We're just checking in with you. This anodyne kind of communication actually is very important to do as a control, because we now know from many studies that a letter like this actually affects behavior. Probably because the taxpayer infers, hey, the tax authority knows I exist. They're watching me. And so that is an important control to understand the effects of the kinds of communications that follow. The letter could say, you will be audited. The first RCT in tax was done by me for the state of Minnesota many years ago now. What is it, 3 decades maybe? And that was the nature of one of the treatments. It basically said, you will be audited. I'm pretty sure the word we used wasn't will, but it was pretty darn close. Or it could say, you will be audited with a certain probability. Now we know a lot of people don't get probabilities very well, but we can vary the probability. Remember, these are randomly assigned notifications. So not everybody gets the same letter. Not everybody gets any letter. So you could have some of the people get a probability of 10% and other people get a probability of 90. The communication could say, we know something about you that suggests you might have cheated in the past. That kind of letter has been used to study value-added tax enforcement. The letter could say, here, by the way, if you're thinking of cheating, here are the penalties for getting caught. So you could have a letter about the P of the Allingham-Sandmo model. You could get a letter about the F. And so those are all deterrence communications about deterrence, but there could be non-deterrence communications. It's your civic duty to comply with your tax liability. Most people like you comply. Or finally, here are the wonderful government programs that tax revenues support. Now, a free rider would never take that seriously, but certainly interesting to see if it changes behavior. Or, as it's been sometimes put, if everybody evaded, here are all the wonderful government programs we could not provide. So we do what you do is you randomly do these communications. And if you do the randomization right, any difference in subsequent behavior relative to previous behavior, ideally, will tell you what the impact of receiving this communication is. So I'm now going to talk about some examples of this. In Argentina, Ortega and Scardacini have done a series of papers. I list here just the reference for just one. They randomize, what they're interested in is the effect of the delivery mechanism. So they try to get exactly the same communication and send it to some taxpayers by letter, to some taxpayers by email, and sometimes a tax inspector knocks on the door and delivers the communication. Well, the results are maybe not a surprise, but it's always good to verify what your prior is. Personal visits by a tax inspector are more effective than impersonal methods, such as an email or a letter. Of course, from the tax agency's point of view, that's important, but not enough, because personal visits are also much more expensive. Phone calls effectiveness are between a letter and an email or a personal visit. So this next paper by Bonning et al., and I'm one of the als, so I'm a co-author on this. This was an RCT done working with the IRS here in the United States. And the issue was about compliance by businesses, a sample of businesses that the IRS suspected might not be keeping up with their remittances of Social Security tax and withholding tax, but didn't have the resources to do the usual follow-ups. So we used that sample and we divided the sample randomly into 3 groups. One group had no additional interaction with the IRS. One group, about a third of them, had a revenue officer go to the business and deliver the message that the IRS considered them to be at risk. And another 1/3 got a letter with the same information. What did we find? Large immediate effects of the revenue officer visit on remittances by the firm. And those effects persisted for at least 4 quarters thereafter. We only had data for 4 quarters thereafter. So at least 4 quarters thereafter. The letters mattered, but in a substantially smaller way and a substantially less persistent way. So their effects here are quite consistent with what Ortega and Scartassini found. Our study is about businesses and not individuals, though, and our study can get into the dynamics of the effect more than their study. One RCT I really like is by a group of authors, Bergolo and others. This is about businesses. Again, it's in the context of Uruguay. Once again, it's an RCT. They all, in a control group, the control group got this letter like the first one I had on the earlier slide, just, hi, how are you? Here's how taxes work. So the treatment effect that's measured is relative to getting that letter. So it's not the letter itself, the effect of the letter itself they're measuring. And in the treatment arm, there were information about audit rates for businesses like that and penalty levels. So this is certainly going after the effect of deterrence. They vary the audit probability communicated. In one treatment arm, they state that if you cheat, it increases your chance of being audited. And they also try a non-deterrence treatment, listing a set of government services that could not, there's a word not being missing, that's missing there, that could not be provided if evasion in Uruguay ceased. And they do a lot more. It's a really careful, interesting paper I recommend everybody read. They make a fairly, to me, is a controversial claim about what they learn. So I am very convinced about what they report that the effects of these treatments are, but I'm not yet convinced about how they interpret them. So what they find is providing information about audits had a significant effect on tax compliance. But they say the way it affected compliance is inconsistent with the deterrence model. And they offer an alternative model, which they call risk as feelings. The basic idea is that when you get a message about audit, it generates fear and induces probability neglect, which is certainly not Allingham-Sandmo, which is all about probability salience. So those of you working in this field, I recommend this paper, and I recommend an open mind about how they interpret their findings. Okay, another really good study is by Naratomi, which is in the AER a couple years ago. This is about the Sao Paulo effort to reduce evasion of the value-added tax, where the tax authority provided monetary incentives to retail customers to report evasion by firms. So the retail firm is supposed to be providing a receipt and is supposed to be remitting tax on the basis of their sales. if the consumer gets the receipt, there's a number on there, which once this program was in effect, allows the consumer to go online and check whether in fact that retailer remitted the tax they should have. Consumers who do that get tax rebates. They're entered into lotteries in return for requesting receipts. And as I said, they can check online firms' reports of their transactions with the consumer online, and they can report any discrepancies. Sao Paulo is not the only place that has a similar kind of program. This is a deterrence framework, because the idea is once retailers understand that consumers can check up on them and report them, it increases their perceived probability that evasion will be detected. This paper finds that, in fact, retail firms increased their reported revenues by 22% compared to a control group of wholesale firms. The wholesale firms were not part of this program, and so they're going to go up and down with the business cycle like the retail firms, so they're a reasonable control group. 22% more reported revenues over a 4-year period. Fascinating study I recommend to everyone. Third-party information, of course, is critical to tax enforcement. That's why the objective probability of detection for me is 99%. It's because the University of Michigan tells the IRS how much they paid me. And if I say something different, their IRS computers are going to track me. So let me talk briefly about a study about a different kind of third-party information. So in the US a few years ago, the IRS required credit card companies to report to the IRS how much businesses received through their credit card. The idea was to increase compliance for small businesses in particular. This is the Form 1099-K. So now, if I'm a small business, as of next year, as long as I have transactions of at least $600 a year, MasterCard and Visa and American Express, et cetera, are going to tell the IRS how much I got, how much money I got from my customers through credit cards. If I'm paying attention, I can guess the IRS is going to notice if I report revenue less than the sum of the credit card revenues. And so a very simple theory suggests that firms like me I should report revenue at least as much as what's on this Form 1099-K, at least as much, probably a little more, because the IRS might expect I got some payments in cash, so I have more than what the credit card companies said. Now, it's important that this program does not report cash receipts, and it doesn't report expenses, which I'll come back to in a second. So in a study of this, we used IRS data to study the impact of this new 1099-K. What did the IRS hope happened? What they hope happened is that businesses which were underreporting their revenues now report at least as much as the 1099-K. And sure enough, we find clear bunching of reported revenues just above the sum of the amount on the 1099-K forms. We find large effects that that the new information reporting affects certain firms, the small firms that otherwise would have reported less. But it turns out it's a fairly small effect in aggregate, because the firms that this affects constitute at most just 15% of the revenue of the number of firms that get the 1099-K. One other thing we found, which has now been found by several studies, which is fascinating and important, is that we find that the businesses which apparently increase their reported revenues so that that number is at least as great as what the credit card companies said they received, those same companies increased their reported expenses. Basically, what's going on is the firms say, uh-oh, we're going to have to report more revenue now, so let's increase our reported expenses. Maybe these were expenses they didn't bother to report before, but I suspect that these are made up expenses, and the increased expense offsetting diminishes the effect of the 1099-K on tax revenue. It's also true that the 1099-K doesn't report cash receipts. So one could expect, although this study can't tell, that firms had the incentive to induce customers to pay in cash rather than credit card. I know where I live, there are plenty of retail businesses which give an incentive to their customers to pay in cash, and that could have been another response to the 1099-K. Let's skip this one because I want to leave time for questions and talk. The last thing I want to talk about in part two is public disclosure. Okay, so what does that mean? In several countries, you can go online and search for other people in the country for what they reported their taxable income was and what tax liability they claim to have. In countries with a wealth tax, the same is true. So in Norway, you can go online and search for any other Norwegian, see their taxable income and taxable wealth, their income tax liability and wealth tax liability. So some form or another of this was in place in Japan, no more, but is in place last time I looked for Australia and Norway and Pakistan. Okay, so this is also a deterrence type initiative. The idea is that if you are cheating on your taxes and suddenly now everybody can see what you reported, the idea is that you think that somebody might whistleblow. Somebody might say, tell the tax agency, hey, I know this guy, or I know this woman's business, and there's no way that's all they earn, and here's some evidence. And so the perceived probability of being caught goes up and evasion goes down. That's the idea. Is it true? Do these public disclosure plans actually reduce evasion? Well, it's not easy to study because in all of these countries, when the public disclosure was implemented, it was done countrywide. It was not phased in. And so it happened all at once in Norway. It went online all at once. So it's always going to be difficult to convince somebody that if tax revenues went up after that, well, was it because of the public disclosure, or was it because of 50 other things that happened in Norway that year? You know, the oil price went up. So you need to be clever, as usual in this field, to try to get a compelling measure of the impact of public disclosure. So I've done studies of each of these countries. So I'm going to now talk briefly about what I think are arguably clever ways we identified the impact of public disclosure in Norway and in Pakistan. Okay, first Norway. So Norway puts all this information online all at once for the whole country in a given year. So how do we know what the impact on reported tax revenue and tax liability was? So our identification was this. Although this happened all at once in Norway, before public disclosure online, in some parts of Norway, what happened, the pre-internet disclosure was you could go to your local tax authority and there was a booklet there that you could look at and read tax liability and reported tax for people in your town. So you had to sit there and read it. But in some towns, the local football team, and I don't mean American football, I mean football, the local youth football team would go in and make a copy of this booklet and go door to door and sell it to raise money. So that means there was some kind of public disclosure in those towns, because presumably lots of people bought this to donate to the youth football team, and maybe they shared it with their neighbors at a cocktail party. We know which towns did this and which towns didn't. So here's the research design. Did public disclosure on the internet increase compliance more in those towns that didn't have the football teams doing this compared to those towns that did have the football teams doing that? Because in the towns that had the football teams doing this, the internet disclosure was not effectively as big a increase in effective public disclosure. And sure enough, it's true that the Norway doing public disclosure on the internet increased reported taxable income and tax liability of self-employed people only, for reasons I've already discussed, more so in the towns without the implicit disclosure from the booklets. So I think that's arguably clever. Let me tell you about Pakistan, and then I'll move on to part 3 of this talk. So Pakistan puts their income tax, their tax liability and taxable income online all of a sudden 1 year, more recently than Norway. How are we going to know if tax liability and revenue collected goes up? How are we going to know that's what did it? Could be 50 other things, right? So here's what we did in Pakistan. So Pakistan, when they reveal information about taxpayers, what they reveal is basically just the name of the Pakistani taxpayer and what their reported taxable income and tax liability is, just the name. So I remember well being in this very office and seeing, looking at what a page of the disclosure is. And eventually we came to a page which had 40 names which were identical. Then we looked at the next page, 40 more names, and the next page, 40 more names. Well, the way Pakistan did the public disclosure, if you have a very common name, there is no way somebody could tell whether that's you or one of the other 500 people that have exactly the same name. So one of my co-authors were both Pakistani, and they came up with a way to measure carefully whether somebody's name actually revealed which person it was. So we have a measure of how common a name a taxpayer has. And so what's the research design? We hypothesize that the impact of the internet disclosure is going to be bigger for people with rare names because they're actually disclosed. Their information is disclosed compared to people with very common names who are not really disclosed effectively, because no one can tell which of the 500 people with exactly your name it is. And sure enough, holding constant lots of other things, the change in reported income and tax liability of people with rare names in Pakistan and who are self-employed, that's important, was bigger than for people with very common names. So you got to be creative, as I think is almost always true in this field, to learn about the impact of public disclosure, but it is a deterrence-based enforcement initiative that is now in several countries. Okay, part 3, final part. I'm going to talk for 15 minutes about a study that I just completed to give you a sense of more details about a given research design. And so this is about a recent IRS program, which says that for certain debtors, tax debtors, the government can revoke their access to a passport. And we're going to see if and how that affects compliance. So this is a little bit different. than what we've been talking about so far. We've been talking about studies which look at the impact of enforcement initiatives on compliance. This is about the impact of an enforcement initiative on paying off tax debt. Of course, these two things are related. If the IRS or the tax agency can't get people to pay off their debt, that means the effectiveness of any other enforcement initiative is less, because people might admit that they owe money, but if you can't get them to pay, it's not very effective. Okay, so what's the program? It's part of a more general enforcement initiative called a collateral sanction, because the sanction isn't, it's related to some other thing that the government does. It restricts passport access for what are called seriously delinquent tax debtors to be certified. I'll use that word again, to be certified as a seriously delinquent tax debtor. You have to have eligible debt more than a certain amount. As of now, it's $54,000. And you have to not be excluded for a bunch of other reasons: a demonstrated hardship, bankruptcy, etc. But if you are certified, what happens is that if you have a new passport application, it will not be approved. So the IRS is in communication with the State Department. You can't make changes or renew an existing passport. And in certain cases, your existing passport can be revoked. So that's been fairly rarely done, but it is certainly possible. So question, research question, what is the impact on this set of programs on how people handle their tax debt? That's the question. This is an example of a collateral sanction. Some people have argued that it can, under some circumstances, be more effective than the usual financial penalties, or even jailing for reasons of salience or reputation effects. One of my former students, Yulia Kuchumova, has formalized the rationale for the use of collateral sanctions. And we note in the paper that collateral sanctions, in the United States at least, have been used for tax purposes before this program. FHA is Federal Housing Authority, so your eligibility for a favorable mortgage through the federal government can be affected by tax debt. You cannot be allowed to contract with the federal government if you have some tax debt. And US states have used collateral sanctions in various ways. In California, your driver's license and vehicle registration can be revoked. In Minnesota and Wisconsin, your law and professional license can be revoked. And in Louisiana, your hunting and gaming permit, which in Louisiana can be worth quite a lot to people, can be revoked. So we have data, we're working with the IRS again. We have data first on the people who were seriously delinquent on their debt. They were told this, and they went ahead and applied for a new passport anyway. They went ahead and applied to extend their passport anyway, and they were denied. So if we can't find an effect of this, then you can bet we're not going to be confident that the program overall had any effect. But we have about 10,000 instances where people kind of ignored the letters they got and were denied a new application, a renewal, or a modification to their passport. This group is clearly treated. They have indicated that they either have or they want a passport. This is something valuable to them. So we can observe the behavior of these people before and after denial and or of a renewal or a new application. Now, there's one technical effect we have to be careful about, which I am going to skip over only because I want to make sure we have time for the question session. But you'll see on the next slide that we have to get a suitable control group, because otherwise we might mismeasure the effect of this denial. And so this is one of those things where I think one graph tells the story. So this is a graph where the y-axis is the share of people who get denied, whether they take some action to eliminate their certification. So in the light brown line, that is the share of people taking such an action. And I mentioned obliquely that you need to carefully construct a control group, and that's the grade. But it's clear that the people who are denied a request were much more likely to take an action to get themselves off back so they could have a passport. One aspect of this program, though, is important in analyzing its effect. Let's say you have $100,000 in tax debt and you are certified. So you're told that you will not be able to renew or get a passport as long as you're in the certified state. It is not enough to pay off your debt to get just under the threshold. So this year the threshold is $54,000. You can't pay off to $53,000. That's not enough. You got to completely wipe out your debt. And that actually affects several of the things we do in this paper. Okay, so it is clear that if you're denied a request, that induces people to take an action. That action could be they pay off their debt completely. It could be they enter into an installment agreement with the IRS, where the IRS and the taxpayer agree that they'll pay a certain amount every month until their debt is gone. They could enter into what's called an offer in compromise. So the IRS and the taxpayer agree that upon a payment of this amount, which is less than what they owe, their debt is going to be excused. So there's several actions which they could take, and this graph is all those actions. Okay, so if you're actually denied a request, you're much more likely to do something to be able to get your passport back. Probably a more interesting question is what happens when you are told you're certified. So you haven't had a passport denied yet, but you're told, you get a letter from the IRS and the State Department which says you've been certified. You have over the threshold of debt. You're not in one of the exempt categories. If you try to get a passport or extend your passport, it's not gonna work. And so the question is, what do those people do? And for that, we take advantage of an RCT embedded in the certification program. So when the IRS rolled out this program about 3 years ago, they, based on the last 4 digits of the Social Security number, which is random, they held out 5% of taxpayers that would otherwise have been certified, but they were not certified, in part so we could study the impact of certification. And so that's what we do. Again, there's a technical glitch because some of those 5% that were held out, something happened in the interim, so they were certified for another reason. So we have to be careful about that. Bottom line is we used an instrumental variables approach where the Social Security randomization is the instrument, and so that's like an intent to treat. What did we learn? Well, before I tell you what we learned, let me just show you that. So this is an IV. The outcome is something like, did you pay off your debt? Did you enter into an installment agreement? And we want to understand how certification, cert here, affects that. But the certification is not pure for what I discussed a minute ago. So we have a first stage where the probability of being certified depends on your social security number, and we can back out an estimate of the impact of certification. And sure enough, certification, according to this analysis, affects the actions people would take to get decertified. So let me just tell you what these things mean. These columns, the positive coefficient says that being certified affects positively the probability you did these things. So in the first column, IA is installment agreement. So being certified affects the probability that people enter into an installment agreement. And in the bottom row, you can get a sense of how big the effect is. So people who are certified were 17% more likely than the control group to enter into an installment agreement. The second column, OIC, is offer in compromise. That's a deal with the IRS that you'll pay some fraction of what you owe. Also, that became more likely for the certified group, 10% more likely. I'll skip to the fifth column. So you're also 10% more likely to resolve your debt by full payment of your debt. So we can get quantitative estimates of how this program, being certified, being told you will be denied access to future changes in your passport, affected compliance. Now, what we don't know, the piece of data we would really like to have that we don't have, is we don't know who has a passport. We also don't know, for those who have a passport, how many more years you have before you need to renew it. In the US, your passport lasts 10 years. So if you got a passport last year, you get certified, and they say, you know, if you don't pay off your debt or otherwise get rid of that debt, you might not be able to renew it. For some people, that's 9 years away. That's not such a salient sanction, but for other people, it is very salient. So we don't know that. And there are two implications of that. One is the fraction of the population affected by this program is smaller than you might think. Not everybody has a passport. Not everybody who doesn't, some people who don't have a passport want one, but not everybody is in either of those two groups. And even if you have a passport, you might not feel salient, a sanction that might not really matter for 8, 9 years from now. So it's a smaller than you might think fraction of the population affected by this. However, it is arguably a very important fraction of the population to take seriously. People who have passports are higher income than otherwise. So there might be more tax revenue at stake. So let me just conclude what we learned from the passport study. It is, we find, an example of an effective collateral sanction. Effective means it changed behavior. People were more likely to take actions to reduce their tax debt than otherwise. It was a very strong response of those people who were certified, ignored the certification and tried to get a new passport, but were denied. The certification also leads to more compliance actions, especially entering into an installment agreement. What I haven't had time to talk about, but the paper also addresses, are whether the impact of this program mattered differently for different kinds of folks. What we would really like to do is see if it mattered more for people who have a passport. I told you we can't do that because we don't know. So we look at things, we look and see whether the effect is different by income, whether it's different by evidence of being interested in foreign countries, like having foreign income, whether it's bigger for people who live on border states, who arguably value the ability to drive over to Canada this weekend and otherwise. We also have a welfare discussion, because from a public finance point of view, it's very important to distinguish between a sanction or any enforcement initiative which is effective in the sense that it changes behavior, it reduces evasion or gets people to pay off their debt. It's important to distinguish effective from increasing welfare, and especially increasing welfare. Just because a program changes behavior doesn't mean it was a good idea to do it. And so we spend some time thinking that through. Okay, last slide. My overall conclusions. I've been studying evasion for a long time. I believe that studying traces of evasion in creative ways can be informative. I believe that these days the gold standard of compelling identification is randomized controlled trials. And governments have shown to be really amazingly willing to partner with academics to do randomized controlled trials. And the kinds of controlled trials are things like contacting taxpayers suspected of non-compliance in different ways. Well, that's exactly the kind of thing that a tax agency might easily be able to do. So compare that to other hypotheses about what affects compliance. For example, if people trust the government more, they're more likely to comply. Okay, that's plausible, but that's very hard for a tax agency to implement a randomized control trial about, right? Tax agency can't really affect how much people trust government or how much people value what the government spends money on. So the kinds of RCTs that can be done are really just the kinds of RCTs that can inform actual policy by actual tax authorities. And finally, there is clear, in my view, compelling evidence of the potential effect of deterrence-based initiatives. Although, for sure, the magnitude of the effect is context-specific, and that's exactly what's under active study now. Why do these initiatives matter more in some contexts versus another? And I'm sure some of you in the audience are actively studying this now, and I hope more of you will do so in the future. So thank you for your attention. I look forward to plenty of time for questions and answers. And let me just put on your screen for a minute some references. These are, the first two are survey papers about the things that I discussed. The first one talks a lot about traces, studies of tax compliance. The second, more recent one in the Journal of Economic Literature spends a lot of time on RCTs. And the third one is the paper I talked about last. It's the one about the passport program.